Welcome to the Stock Play of the Day Overtime. This week on the Stock Play of the Day on Monday, we talked about Walmart. Walmart was announcing earnings. We looked at a long call spread going into earnings. Today, we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. As I mentioned, we're talking about Walmart today. So we knew Walmart was going to be announcing earnings after our call on Monday. The stock play of the day usually is goes live at noon on Mondays. So if we go back to Monday at noon, we see that the stock was trading right around 27. I think the number that I have written down here is 127.12 when we talked about our long call spread. Specifically, we talked about doing a long call spread because of earnings. We had a little bit inflated volatility, which the marketplace in general, the volatility has been inflated. So we bought an option contract and we sold an option contract. The expiration that we chose went out around 14 days. We looked at the June 5th expiration date and we centered the strikes around where the current stock was trading. On the high side, the out of the money call option, we sold the 130, giving ourselves about 3 points of upside. And on the low side, we bought an in the money call and we bought the 125 strike call. Now, we did this because we wanted to try to manage our risk by using the spread. We knew that we have susceptibility to a volatility crunch because of earnings. Implied volatility is coming down after earnings is what you would anticipate. And because of that, we did a trade where we're literally have the same amount of upside as we do downside. The midpoint of the trade was $2.50. So for every 1-by-1 spread that we do, the total cost would be $250 plus commission. And since it's a debit spread, that's going to be our maximum risk on the trade. Now, the width between the strikes was 5 points wide. That means that the maximum you could make on that trade would be 5 points. Now, what would have to happen to make that 5 points? You'd have to have the stock finish above 130 at the expiration date of the option contract. And if that was trading for $5, you subtract what you paid for it, $2.50, and hence the upside potential, the maximum you could make on the trade would be the $2.50 minus commission or $250 minus commission. Now, as always on the stock play of the day, nothing's meant to be a recommendation. And this is actually going to turn out to be a good learning experience. We always have tape at noon, usually for the stock play of the day and stock play of the day overtime. So we always have to choose the price of the market while we're taping, obviously, and we are taping live. So with that said, let's just first of all start by looking at the chart. If you put the trade on around noon, the paper trade, I should say, because we're just learning here. If you put that trade on, the market actually did pretty well. And I would have probably considered just not going into earnings. Why? I wouldn't have wanted the risk that would have happened going into earnings. Because the stock right here, if you see my crosshairs, I'm going to highlight that number there, went to 128.54. So it went up about $1.40 after we chatted about it on our stock play of the day call. Now, if you would have done that, you would have been a little sad because earnings turned out to be a good thing for Walmart. The stock ran up on the open, got up to our 130 strike. As a matter of fact, it went beyond. So I'm going to go right about here. I'm not going to take this 1 point on the right on the open. It went to about 130.55. And you probably should have got out on that because we were doing this around earnings. So you would think that if you had a positive open, you would get out of the trade, let implied volatility settle down, and then see what the spread is trading for, and then sell out of it. That means that you would sell to close your long option, buy to close your short option. And hopefully you would do that for a credit larger, obviously, in this instance, you would think, than what we actually paid for it. Now, a lot of times I would wait until maybe 10 o'clock or so and let the stock settle down, see exactly where it's going, see what the trend is. But particularly the stock was trending down after that. So if we waited till the noon hour, we're still trading here. It says 128. Well, right just past the noon hour. It got up to 129.24, but we're going to call it right about the top of this little channel here. 128.91 is where my crosshairs are at. So with that said, then you definitely should have been out. And if you didn't get out, well, then you're going to get the stupid award for doing sort of hanging around. And what's the stupid award? The stock went down with the market. In general, the stock, the marketplace, the S&P 500 index didn't have a very good end of the week, and that drove all stocks down. And one of the stocks that also drove down is Walmart. So don't fret. If you stuck your head in the sand on your paper trade here on Walmart, we're going to talk about something you might want to do. So we're now Friday, it's noon. This is where we're trading at Walmart. And then let me go to the Ally Invest live option chains. Walmart is at 124.80. So we're down a little bit more than $3 on that trade. So because of that, it's down 17 cents, but overall the down movement has already happened. Here's what the strategy was that we put on. We bought the 125 call and we sold the 130 call. Now, because we did a spread, if you see this, the 130 call still has 57 cents in it, and the 125 call is now an at the money option contract. So because that is at the money, if I were to get out of the trade, I would want to do it now. I'm long an at-the-money option contract, and that's where all the juice, quote unquote, of an option usually lies. There's more time premium on at-the-money options than on in-the-money and on out-of-the-money option contracts. So because of that, I would strongly consider getting out of the trade right now because you're getting an inflated valuation on the one that you own. So because of that, and I'm going to show you this here, the midpoint is 162. We paid 250, down about 90 cents overall on the trade. Considering the stock went down to 125 right now, or 124.80, I think that's where 124.80. Considering that happened, that's not bad. Because we did this spread, we're not hurt as bad on this trade overall. Okay, now, with that said, you should have been out on the day that you had the big move up. After volatility settled down a little bit, the stock was trading close to our strike that we were targeting, the 130 strike. That's when I would have considered getting out. But if you're in it now, you got a situation. You'd be down on this trade. And whenever we do the stock play of the day or whenever I'm chatting, it's always just trying to learn. So on trades that do well, there's not too much to learn. The stock goes up and does what you want it to do. You sell it, you get out, take your profit, you move on to the next trade. But now is where it gets interesting. Okay, let's say we stuck our head in the sand. We ignored the earnings. Now it's Friday. You wake up, you're like, oh, I have a long call spread on. It's going to expire in June. I probably should get a quote on Walmart. Walmart is now trading at 124.80. We see that I could sell it and get out. Well, good. It's at the money. It's at my 125 strike, so I can get some juice there. It's still trading for $2.18 because it's at the money. That's all time premium. So if I look at the profit and loss graph here, this is what the profit and loss graph looks like on just that spread. This would be as of today. So I would consider getting out and just selling it. Now, what's an alternative we could do? Would have worked a little bit better if you would have did it maybe when the stock was at 126 or maybe 126.5. But we can roll this into a butterfly trade. And this is something that I would like to do with long spreads. You take kind of one shot. I don't want the cheese anymore, but just let me out of the trap. So how would I do that? We have our long spread on. Well, to turn this into a butterfly, all you do is sell a credit spread around it. So a butterfly is one long call spread and one short call spread. That in order to make this a butterfly, you would sell another one of the 130s, and then you would buy the 135s. So in this instance, if I sell the 130s and I buy the 135s, I can bring in about a 40-cent net credit to the account. Okay, so I'm going to remove this option right here. I'm going to make that quantity 0. All right, and now you see you got a 41-cent net credit to the account. So let me tell you what this does. I paid $250 for this trade. If I sold it, I would get $160 for the trade, approximately, if I could fill at the midpoint. Never a guarantee on midpoint fills, but that's approximately. I would be down 90 cents on the trade. What's an alternative? How about we roll into a butterfly? And then I'm not taking all my chips off the table, but I'm going to bring in 40 cents, approximately half of what my loss would have been. that would lower my cost basis on this trade to $2.10. But I'm still in the game. So let's go back and add this and make this a butterfly. Okay, concentrate on my screen. I'm adding that long strike that we had. I'm putting that back in. I'm going to add another short because that's what we'd be selling. And then we have the one long option contract. Now let me go down here and regraph this. And you see, now we have a butterfly on. Okay, why is this interesting? We're going out to the June 5th expiration. And so we got some days for this to live. The underlying stock is trading right around here, right down here on the 125 strike. So I have a range now between 125 and 135 that could be profitable to me. So this is why I say I don't want the cheese anymore. Just let me out of the trap. The maximum I could get would be 130, would be at, if it stopped right at 130, I could make $5 on this trade, but good luck with that, right? The stock would have to expire right at 130, right at expiration. So an alternative here is to put this on, bring in that 40-cent net credit and hope that I can let this stock ride and it stops somewhere between, well, ideally would be 127 and 133. Why is that? Because now I'm in this butterfly for about $2. So that's where our break even would be on that trade. So if it stopped at expiration somewhere within that range, I could get out of this trade without a loss to my account. Now, stock continues on down. Obviously, I'm going to lose that $2.10. Stock skyrockets up. I could still lose that $2.10. But overall, this gives me a shot. I'm not out of the market. And here's one of the biggest things that I see at beginning option traders is they struggle with selling a loser. Oh, Walmart announced earnings. The stock went up and I didn't get out. Oh, I'm sure it will come back. And they just start playing the hope game. They can't close out the trade and move on. And I think that's the hardest thing for beginning option traders is they have a plan. They didn't stick to their plan. So this is a great scenario. We're going to look at Walmart going into earnings. And earnings came out, stock popped up. We didn't get out of the trade. We didn't stick to our plan. And now we got a situation. So I don't want the cheese anymore. Let me out of the trap. That would be the theme for today's show. And that's going to be it for this episode of the Stock Play of the Day Overtime. Now, on Monday, we will not have a Stock Play of the Day, which means we won't have an overtime either on Friday. So because of that, the markets are closed. And I just want to let you know that you need to subscribe now and ring the bell so you get all the alerts for the next Stock Play of the Day. Thanks for coming. Thanks for listening. And we'll see you next Monday. All right. Thanks for coming.